The market believes that the Bank of England is done. The market believes that cuts are coming next summer. Do you believe that, and is the market being a little overly optimistic?
On balance, I think it is probably being a bit over-optimistic, not because we expect more rate hikes. Actually, rates have now got to a pretty restrictive level that you see now is actually working on the economy in the way the Bank of England wanted. And we're still at the stage where, take the housing market, effective mortgage rates on the stock of mortgages have risen by only about a quarter as much as interest rates on new mortgages. So it's still passing through. There's a lot more contraction to come from the restrictive level of policy that's already in there. So they'll probably sit tight, but they do need to see wage growth coming down, services and core inflation coming decisively down before they come off. So this isn't a normal interest rate cycle. They may have got to the peak, but we're not turning around quickly.
Alex, hi, it's Alex in New York. We're very excited to talk to you. Bank of America actually said they don't expect the first cut until 2025. Clearly the market is not pricing that. When do you think the first cut would happen, and I guess the why behind it?
I think probably that's at the other end of the spectrum, that 2025 number. So late 2024 seems plausible to us for the reason that the Bank of England does need to squeeze down inflation. So rates need to stay at restrictive levels for quite some time. But let's not forget, the bank's interest rate setting is now pretty restrictive. In our calculations, it's similar to the Fed having gone to something like 7%.
Wow.
And that's because the Fed's facing a fiscal policy that's pushing up growth, and a consumer with lots of pandemic savings that is running down that's also pushing up growth. The Bank of England isn't working against any of those forces to the same extent. So what's happening in Europe and in the UK is that this, even though central banks have done something very similar, is actually starting to have a very different effect.
Is the danger, though, that we end up importing tighter policy from the United States? The Treasury curve has moved up, the long end has moved up quite significantly, and looks like it potentially could stay there. That bleeds into gilts and effectively ends up importing tighter monetary policy.
Well, there's no reason why it necessarily should. And you take the long end, well, this is very interesting to us because the market's pricing a Bank of England policy rate in a couple of years' time that's basically the same as the Fed's policy rate in a couple of years' time, which for an economy that isn't facing the upward pressures on growth that the US is facing seems, how should we say, notable to us. So we like the long end of gilts. We like the long end of core European bonds for that reason.
Alex, are you surprised that the data, though, from the UK isn't weaker than it is, to be honest? I feel like it keeps surprising me to the upside.
We have had a few kind of upside surprises, but take a step back. Look at the last, I don't know, year, 18 months. Basically had very little growth in the UK economy. And given this monetary policy setting, not likely to have much growth for the next 18 months either. And that's a 3-year period of broad stagnation in the economy. So even if there isn't an outright recession in that time frame, it's actually a very weak, by historical standards, three-year period.
Is it enough to get inflation back down to target? Because there is a certain sense that maybe inflation expectations in this country have become a little bit more de-anchored than elsewhere. And as a result of which, the bank maybe needs to do more to ensure that we get inflation back down to 2%. Can it cut until it sees really concrete evidence that we are going to get there and get there convincingly?
I think the bank will feel it has to be sure before it cuts from here. But let's not forget how restrictive the current level of rates actually is. They've got to a point where they don't need to keep doing more in order to squeeze inflation down. You're right, inflation expectations have slipped, wage growth has become more embedded. They will feel, I think, that they need to squeeze that down to get inflation back down. But rates are now at a level that will actually do that, in all likelihood. You see that now in job vacancies coming down, you see it in mortgage numbers, you see it in some of the PMIs pointing to softness. So monetary policy is at a restrictive level. It is working, and I think they will feel that now's the time they can be patient and allow the medicine to work.
This raises another question too, Alex, is that are the models that you would have used when you were at the BOE, do those models work anymore? Because if you use those models to look at the data then tell you what to do to monetary policy, there's talk that those models are kind of obsolete at this point.
Well, I think all central banks in this new regime are facing the challenge that the thing that matters more than ever is what's happening to inflation expectations, as you were just describing, and what's happening to the supply side of the economy, what's happening to how much the economy can actually produce without overheating. The Fed's been facing exactly the same challenge. The ECB's been facing the same challenge with the energy shock. And so central banks, like the rest of us, are adapting to a need to focus more on supply side factors than on where's growth growth heading in the next couple of quarters. So it's not so much that the models are obsolete, it's that they're incomplete. And this is something that all central banks, I think, are grappling with now.
There is an argument kind of regarding where we go next and how the bank thinks about policy that kind of suggests that the bank and the Treasury have the QT program and how it's unfolding is basically causing some significant losses. And those losses are manifesting themselves at the bank, and then they're manifesting themselves at the Treasury. And we're having to take... And that's having an impact on the primary deficit in terms of the way that the government can spend money. And I'm wondering whether or not you think that this is going to become a problem further down the road, and whether or not this is a good use of kind of government funds, and whether or not what I'm really trying to get to is how fiscal policy and monetary policy are going to interact, how the losses on the QT program are going to restrict the fiscal side, and ultimately kind of how those two are going to end up working together. Do you think we've got a problem here that has yet to fully emerge?
I think it has yet to fully emerge. I don't know how much of a problem it will be.
Right.
So with the transfers from the Treasury to the bank, remember, there were a lot of transfers in the other direction from the bank to the Treasury.
But we're now having to deal with the negative side of that.
Now they're coming back, and now we're in the negative side of things. But effectively, because the UK has financed its debt with shorter-term funding as a result of QE than longer-term funding. And that hasn't risen as far up the agenda, perhaps, as I would have expected so far. But the bigger issue here, both for the Fed and the BOE, is that fiscal policy, particularly on the US side of the pond, is a lot looser than it was before the pandemic, and that means monetary policy is having to work harder to lean against it.
Do you think, but the issue of these losses, do you think ultimately, given how much government is having to pay, A, to deal with the losses, and B, to deal with debt interest, do you think ultimately that current rates are sustainable? Do you think... That's really what I'm trying to get to here. Do you
think
interest
rates?
Can the government afford, A, the losses on the bond market portfolio, and B, the interest rates that the government that effectively the government is being charged?
So it can afford it, yes. But this level of interest rates with this rate of growth poses quite a big challenge to the fiscal arithmetic on both sides of the Atlantic, actually. And what it means is either we're going to see over the next 5 or 10 years a rising level of government debt to GDP pretty sharply in the US, or we're going to see fiscal policy need to consolidate quite sharply. Now, you can comment on whether you think that's likely or not, but this is a key feature of the new regime, and it's one reason why, even though long rates have moved up so much, particularly in the United States, we're still over the long term cautious about prospects at the long end, because you've got a fiscal position where the arithmetic is actually quite unpleasant and challenging.